And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is Kevin Conard, who's the CEO of the Retirement Planning Group with approximately 900 million in AUM. Kevin, thank you very much for being on the show.
Not a problem, Adam. Thanks for having me.
So, Kev, can you start by telling us your story and how you got involved in the business?
Yeah, for sure. So I graduated in 1998 and started out in advertising, and quickly realized I didn't want to finish my career pulling all-nighters, writing ads for various clients. So I ended up in the brokerage world, working at about 4 different brokerage firms in 1999.
Okay.
And quite honestly, at those brokerage firms, I learned a lot about how not to run a business, how not to treat clients. So it was excellent learning in that capacity. But ultimately, my business partner and I figured out that was not where we wanted to be long run. So in 2004, we left in the dark of night and took a small number of clients with us.
Right.
And we ended up starting, like I said, the Retirement Planning Group in 2004 with about 100 clients, and was roughly $23 million under management. So that was my entry point into the registered investment advisory space.
Oh, wow. That's a great way to get into it.
Yeah, no, it went quite a different direction at a certain point. So we primarily spent all of our time working with clients who had never worked with anybody before, and they were really looking for a quarterback that could help them pull together all their finances. So what I mean by that, we kept tripping across people that had an advisor here, an advisor there, an insurance guy, across town, maybe an estate planner. They might have left a couple 401ks behind, and they could never find anybody that would pull it all together in a comprehensive plan. So we started doing that sort of planning work, actually as far back as the early 2000s. And that was our first set of clientele, and quite honestly, it still is today. It's people basically looking to answer the age-old question: have I saved enough money to not worry about running out of money in retirement? And then the other question we're always answering is, am I on track to do what I want to do?
Oh, wow.
And that's how we've built the entire firm. I did take a small hiatus from the firm in 2013, and we went and started up a robo 401k advisory solution for people that had 401ks out there. And the name of that company was Bloom, with 3 O's. And it's still in existence today, and it's doing quite well. I came back to the Retirement Planning Group in 2017 to bring a lot of what I learned there back to this company. And that's the brief synopsis, Adam, for how I got to where I am today.
No, that's a great story. So just to recap, you started off in advertising, realized very quickly you didn't like it. You moved over to brokerage, which I'm assuming just Series 7 registered rep kind of style, buy and sell and charge commission?
Yeah, it was. We fell more under the fee-based program they had at the time, but there was no doubt it was a sales-oriented, commission-based business that left a bad taste in our mouth.
You didn't like it, and then you moved over and you realized the future is just an independent RIA, and that's when you made the plunge back in 2004. And then you realized something very smart where the audience, or the clients, if you will, not audience, but the client is fragmented. There's a lot of advice out there, but it's just fragmented. So you wanted to bring everything in-house, and that's how you were able to grow the business. Is that a good recap?
That's a very accurate recap. And if there was some minor inspiration, it was or major inspiration. My dad is a small business owner. I used to ride around in the car with him to his accountant, and then ride around to him, to the bank. And I knew he had an insurance guy, and I was like, this is kind of a train wreck for most people, and none of it's working together. And so, yeah, that's why we built the Retirement Planning Group. And, we don't just do the planning now. We also manage the assets to help fulfill the plan. And then we also have an entire tax division in-house with CPAs on staff that can do the client's tax return for them.
Oh, wow.
And then we also have added in identity theft protection, either free or discounted, for clients that are coming our way. So, and most of our clients, honestly, are now coming to us nationwide. It's interesting. Geography is no longer a prerequisite to finding a great advisor. Most people would rather have a great advisor that they visited with via video conference than a so-so advisor that happens to be, 2 blocks away.
No, understood. So I guess, Kevin, there's 2 questions that pop up in my mind as you're giving your story. One, a lot of people ask, how do you find clients? I mean, when you were back at the brokerage shop and when you went off on your own, I know a lot of other RIAs have a difficult time making that leap or just going off on their own and leaving a bigger umbrella or a bigger brand. What's a good way that you found clients in the early days and then also find clients today?
So yeah, the way I found clients in the early days was what I refer to today as golf cart marketing. So you're finding a couple clients, you got to luck out, have a little bit of luck on your side, and then you're taking them out to play golf all the time or doing super one-on-one events with them, and you ask them to bring somebody with them, and then hopefully that person's interested, hopefully that person's qualified, and you spend a lot of time doing that. And to grow a company, if you're managing $10 million and you grow it by $1 million a year, you can throw yourself a miniature party and say you grew by 10%.
Right.
But $1 million growth over a $10 million book could be 1, 2, 3 clients.
Right.
To get there. So that's how we did it early on. More one-on-one. We did seminars, things like that around town. The market's changed a lot. People now are so conditioned by an Amazon shopping experience that they do a tremendous amount of research on the firm online. So you've got to skate to where the puck's going, right? And so people are often making their decisions before they ever come in the office just based off of your website, your engagement, and what have you. And so today, the challenge of growing a firm from 800, from what was, early on 23 million to 100 million to 200 million, you could get away with the golf cart marketing. But when you start to get to 200, 300, 400, and to $1 billion, and you want to grow by, say, 10% a year,
right?
We got to bring in almost $100 million in assets, and that's really hard to do through a golf cart.
Right.
So we spend our time. 75% of our clients come from digital means now. And so we have a tremendous, I'd say, property or footprint and use a lot of tools and techniques to attract new clients. And we do that by being extremely friendly and extremely easy to work with.
Gotcha.
That's my answers for, how did we grow early? How do you grow today? And there's a lot of men and women out there who are still doing it the traditional way.
Yeah.
Totally great. But I know we have such an incredible offering. I'm trying to get it out to as many investors as possible.
No, that's a great way of doing it. So the second question, Kevin, that I had as you were telling your story is, can you tell us a little about the investment strategy? How do you play the game? Are you fundamental? Are you technical? Speak about that if you don't mind.
Yeah, I would say we have a fairly meat and potatoes investment philosophy. We start with the planning side of things first, as I've mentioned already, and then we back into the portfolio that a client should have. How we construct that portfolio is predominantly with indexes. We find them to be extremely efficient and extremely cheap to own, and basically zero cost these days to buy or sell into those positions. So it helps us with our costs, overall costs. The more we can keep costs down, as you know, the more it stays in an investor's pocket. So we build most of our portfolios are built with indexes. We have a little bit of an active slant on the bond side.
Mm-hmm.
And then we do utilize some third-party tools for some tactical shifts we can make with the stock component of the portfolio, where we look at things like momentum in different sectors, investor sentiment, and then some of those markers, and we make some tweaks to the portfolio if we feel things are softening up, or if it's still a good time to be an investor.
Gotcha. So is there any, I guess the next question would be, how do you handle risk? And what mistakes do you see people make with respect to risk management?
I think what we start with is defining, what is risk? We define risk as the risk of not hitting a financial goal or running out of money in retirement. I mean, I think that's the true risk for most investors out there. Again, that's why we do all the planning side. Unfortunately, I think when I look back at how most people identify risk, obviously they look at the risk of losing money,
right?
And that's where they make their biggest mistakes. They often confuse risk with volatility. Volatility is no big deal if you have a well thought out investment strategy and you got a really well diversified portfolio. The risk of it going to zero is extraordinarily low. If you're playing in individual stocks, I've seen it happen, unfortunately. Prospects that came to our office that started and were toying around with 5, 10 positions or one position, and they did risk a tremendous amount because the volatility was so great, and the company itself went out of business. So I think we define risk differently. When I look at some of the other mistakes people are making, Adam, people show up to our door all the time with just a hodgepodge of stuff. And trust me, I get it. It's like, where do you start? So you go Google investing and you just opened up Pandora's box. You don't even really know where to start.
Right.
And it's been my experience. Think of it this way. If you were going to go build a house, you wouldn't just, step one, run out and buy a bunch of 2x4s and a few bags of cement and a shovel.
You'd hope they wouldn't. Right.
Right. No, right.
Right.
You'd start with a blueprint.
Right.
And then from there, you'd figure out, well, okay, I need 2,000 2x4s to build my dream home. And again, for some reason, investors go about it the exact opposite. They randomly guess at their 401k options. They invest a little bit here and a little bit there. Maybe it's a few mutual funds or a random CD at the bank or an annuity. And at the end of the day, it's just a pile of 2x4s, a few bags of cement, and a shovel.
Right.
We take that approach, you have almost zero chance of hitting your dream financial goal. And I think ultimately that's how we define risk here, is not having your portfolio set up correctly, because those can cost you tens and hundreds of thousands of dollars, either in the near term or long term.
So just explain to the audience, if you don't mind, Kev, the difference between volatility and risk, which you mentioned earlier, just so they can understand what's being said, if you don't mind.
Right. Absolutely. So when I say confuse risk with volatility, if a client, it's really an education issue. So I'll start with volatility. Volatility is nothing more than the frequency in which an investment goes up or down and how rapidly in value it goes up and down.
Okay.
So something that's extremely volatile might be an international mutual fund or investment. Something with lower volatility might be a bond fund, because the values of those don't traditionally move around in value a whole lot.
Right.
So investors often, again, confuse risk with volatility. So if you have something, say, fairly volatile and it goes down, they view that as risk. We view something that goes down in value as an opportunity to buy more. So oftentimes I think they confuse the two. I think it's most important, and the media hasn't done us any favors. That's a risky investment. I mean, that's what you hear all the time. And what you really have to understand is, what is the risk? Is there really a chance it goes to zero? No, there's almost no chance this position could go to zero. Understanding, however, if you own one stock, yeah, of course, it could go to zero and stay at zero and you never recover. And then you have to marry that with the time frame that somebody would need access to the funds. So I don't know if I did a great job, but I think understanding the volatility of a position doesn't necessarily correlate with the risk of losing money. Because, most things that go down in value that are well diversified come back in value and are worth even more at some point in time.
So just to recap, to make sure I understand and help explain it, volatility would mean the rate at which a market or a stock or an index or whatever the holding is, a position, would move up or down. So a low volatile stock wouldn't move that much. A high volatile position would have big swings in price up and down. Whereas risk, if you're saying, hey, I'm invested in the S&P 500, that's not going to zero. It doesn't matter if it's a highly volatile period or not a highly volatile period. What matters to you is the efficacy of the underlying fundamental research that you've done to diversify the portfolio to make sure that investment doesn't go to zero. And therefore, instead of panicking when it goes down on a highly volatile period when there's downside volatility, you're buying more because you're taking advantage of other people that are panicking. Is that a good way of explaining it?
It is. Look, I can summarize it in this example here. When you go to look, I'm a huge ice cream fan.
Yep.
I love it. Like, if it's in the house, it's gone.
Yep.
So if I go to if an investor goes to the grocery store and they see a gallon of ice cream that's on sale 25% off, they're going to buy the daylights out of it.
Right.
I would.
Right.
Right. But if I rename that store and in that same freezer section, I put I put S&P 500 fund, and I said 25% off, no one would touch it with a 10-foot pole.
Understood. And that's where you step in.
The volatility is an investor's best friend. The risk I think needs to be defined as, you come into my office, you're 40 years old, and you're telling me you want to be all in CDs for the next forever because you can't stand the volatility. And I help you understand you have an extraordinary risk of never retiring if you do that.
Understood. That's very clear. So you're paying attention more to the upside risk of missing out than, hey, the market goes down 5 or 10% or 20% or even 30%. To you, that's just, it's getting cheaper, it's on sale, let's buy more when it's cheap.
Yes, I'm not worried about what happens to the market in the next 6 months or year. I'm worried about our clients participating in what happens over the next 5 to 10 years.
Oh, that makes sense. Makes perfect sense. A longer term outlook.
But you go to the magazine rack, as you walk by the magazine rack at the grocery store, they're teaching you the exact opposite thing. And the reason they do that is because you'll buy the magazine. Right. It's scary.
Correct.
So there's a lot of education that needs to go on out there.
So I guess the next question, Kevin, what is some timeless investment or just timeless advice you'd like to share with the audience?
Yeah, this is a piece of timeless advice. I think I wish I could get this in the ears of more people starting out their careers. So for your listeners that are new to the workforce, or for your listeners who maybe have, teenage kids or older kids entering the workforce, this is literally the best piece of advice I can ever give anybody. When they're going out for their first job and they're negotiating their salary, there's a lot less negotiation, if we're being honest, early on in your career, right? So if you're being told what you're going to be made, right, and they say you're making $40,000 a year, what you need to instill in that individual is that they didn't hear $40,000. What they heard, or what they should have heard, is $36,000 from day one. Right. Because you're factoring. And they start day one. Yes, they start day one putting 10% away in their 401k.
There you go.
Because here's what I know. I've talked to literally thousands of clients and prospective clients. Life doesn't get easier with the finances. Because you start off probably single in the workforce, then you get married, then you have a house, and then you have kids, and then you have car payments, and you have education payments, and then someone tells you need life insurance, and expenses just go up. To say I'm going to get to a checkpoint and then start saving money is insane. It never happens. And so if you can the best, most timeless advice I can give anybody is day one, if you can pretend you didn't hear what the number was they told you and you heard a number 10% less, you'll never miss it.
Almost like pay yourself first, like you invest in yourself, just put that money aside.
Yes, but you know what? The second we all hear our dollar amount, we're like, we do the budget and we're like, okay, I can spend this on a house, I can buy this, or I can rent this apartment, I can buy this much car. It's already gone.
Yeah.
So you need to just hear a different number.
Got it. Well, that's really good. That's really, really good advice. And then when you accumulate, I guess when you invest that over 40, 50, 60 years with the compounding returns, you're paying that becomes a massive, massive return on that investment.
Yeah, basically, if you do that, you've already taken care of retirement.
Right.
Day one of your first day on the job.
Right.
You've taken care of retirement. You'll get raises, but you still keep saving the 10%. So, next year, if you get a 10% raise and you're making $44,000, now you're going to save $4,400 a year.
Right.
It literally takes care of itself.
Yep. No, that's great advice. And this way you don't have to worry about it when you're 50 or 60 or whenever.
No.
Yeah, it just takes care of itself.
Right.
That's really good advice. So what about some common investing mistakes, Kevin, that you see people make?
Let me start with what I think people are probably pretty, for the most part, people that are interested in investing or, have their finances together, what I've seen people are pretty good at.
Okay.
They're pretty good at saving when they finally figure it out, right? Like if they lean into that advice I just gave you a second ago, they instantly become good savers.
Mm-hmm.
So, there's no doubt about it. There's a saving crisis in America as a whole. But if we're looking at the swath of individuals who do take their finances seriously, people are, by and large, pretty good about saving for the most part. Okay.
Mm-hmm.
But the mistake I see them doing is how they're saving. So I'll use this analogy. This is appropriate for, I guess, wintertime. I would say as a total tangent here, or example, squirrels. Squirrels are extremely good at saving, right?
Yeah.
They go out and man, they load up for the winter. And the winter is their quote retirement, right?
Right.
But there's this little known thing out there, the gray squirrel.
Mm-hmm.
Okay, now most squirrels take everything they got, and throw it in one hiding place.
Right.
The gray squirrel goes out there and I think is a little bit better at it, and honestly a pretty good representation of investors. They don't just collect all of them in one place. They bury them all over the place. I mean, they're everywhere.
Wow. And
they do that because, if their nest gets raided or gets knocked down or whatever happens, they've got these other rat hole accounts, if you will,
right.
Stockpiled everywhere. Now, here's the problem, though. The gray squirrel is really good at helping the environment because most of the time the gray squirrel forgets where he put everything.
Right.
And so it helps the trees grow because they bury the stuff in the ground and you get really dense forests as a result of it.
Right.
So people are very similar. They've got an old 401k here, an old 401k there, a miscellaneous, stock options. And because they just left a job and they leave it laying around like it's an old piece of luggage or a stockpile of nuts somewhere. And a lot of times people can't remember where it is. And so the biggest investing mistakes I see people making are failing to just consolidate it and get it in one place and then hiring an advisor to make sure it's all working appropriately.
That makes perfect sense. So you're basically saying that instead of forgetting it or looking away, just address it and then hire somebody who's qualified to handle it and manage it for you and then move on.
Yeah, you find someone earlier on in your career and they help you with get your 401k rolled over to, say, an IRA. You're a phone call away from the next time that happens in 3 or 4 or 5, 6, 7 years when you leave the next job.
Right.
Or when you go to that next job, they'll sit down with you and tell you how to get your 401k set up.
Right.
I mean,
you forget it. Yeah, it's just too much. It's too much.
It's that simple.
Yeah. No, that makes perfect sense. So, next question I have for you, Kevin. What is the best piece of advice you've ever given or received?
I would say in the financial space, when I started out earlier on, I read this book, and in it, they wrote this gentleman wrote, "People don't care how much you know until they know you care." And I've always taken that to heart, because every investor that's ever crossed the threshold, either virtually or through the front doors of our office, they all have a story. They've all arrived at where they've arrived at. They all have some sort of problem to solve, which typically is why they reached out in the first place. And I think it's really important, whether we use that, if you're in the financial services industry or any industry, a level of care and concern for that individual and is the first thing you need to lead with, because no one's going to listen to you if you truly don't have a genuine interest in their success. And like I said, that applies across all industries, professional industries as a whole. But that was the best piece of advice I've ever received. As far as given, maybe it's maybe it's telling my 3 boys it's time for bed because school's coming early tomorrow. I have no idea. Probably maybe something in that camp.
That's great. That's great. Before we actually started recording, my kids were in the back making noise, and before they walked out the door. So the fact that you cared and you were empathetic about it, and you said, okay, take a second. We just took a minute, went downstairs, gave them big hugs, and okay, see you later. But the caring part is huge, especially in this business. And for some reason, there's just a perception that people don't care when you get to the top. But I've found through my just experiences in life and interviewing, countless people that manage billions of dollars, hundreds of billions of dollars, people care at the top. Not all of them, obviously, but the vast majority, there's an overwhelming amount of people that do actually care. And that human element is that je ne sais quoi, if you will, that really makes that difference, that separates the leaders from everybody else. So that's a really good piece of advice.
Well, thank you. Yeah, I agree wholeheartedly.
So, Kevin, thank you very much. I mean, this has been a great show. So just to recap here, create a diversified portfolio. Start with the planning process. Don't panic when you see downside volatility, as long as you're prepared for it, expect it, and then take advantage of it when it does happen. And then some timeless advice that you shared with us and just mistakes people make is when you look at risk, it's not so much what you're going to lose, it's what you're going to miss out on making if you're out of the market and you panic when the market when you get that downside volatility like everyone else does. And then I guess mistakes is just make sure that you plan and you pay yourself and you plan for savings. So in other words, you plan to succeed. Is there anything that I missed that you'd like, anything that I didn't ask that you'd like me to ask, or before we wrap up?
No, I think you summarized it pretty well. And, the only thing I'd add is kind of piggybacks on the last comment you made before you went into the recap. And that was, I think there are a lot of really great wealth managers out there, especially in the registered investment advisory space. I mean, they're intelligent. They have hearts of teachers. They're out there. Investors, they need to find one. It's not what you know, it's what you don't know. They typically get you. And, if I could empower every single American to go out there and find one, that's what I would leave you with today. Because, like I said earlier, the smallest piece of advice can have an enormous impact on unborn children or grandchildren,
right?
Off of the decisions that are made. And, like I said, there's a lot of great advisors out there who are just looking to help people out. It's a matter, but the actual investor has to pick up the phone most of the time or get online and go look and find somebody to help them. And that's the first step.
No, that's really, really good advice. So the next question, I guess, Kevin, is what's the best way for people to get a hold of you or get in touch with you?
Yeah, like I said, or maybe I didn't say 75% of our new clients come to us via the web these days. And so we're, like I said, it's very easy to get in touch with. If your audience went to planningretirements.com, so it's planningretirements.com, they can hit us up on chat there. They can book a 10-minute complimentary meeting with myself or somebody at the firm, or they can pick up the phone or shoot us an email. We're super simple to get hold of, and just out there to try to help folks out.
Well, I greatly appreciate it, Kevin. Thank you very much for being on the show, and hopefully we'll have you back again soon.
Absolutely. Thank you for your time, Adam. I appreciate it.